Hey, welcome back. Walgreens is currently one of the most searched companies on the market. With the stock reaching close to 90% since 2020, lots of issues but also a real potential of a recovery, let's look into them again in more detail. As you are about to see, there are many fundamental short, medium and long-term issues that required some drastic measures so far, but they are far from being over. But so far, I'd say they did the right things to maximize the potential for a recovery. They had massive goodwill impairments this year, resulting in a loss, but without it, they would actually be on a profit. The cash flow has been about minus 1 billion in the first 9 months of the fiscal year, but the latest quarter was actually positive. I think this investment is all about the turnaround potential. If they can make even close to the 4 to even more than 7 billion they were able to make a few years ago, that would put them at a price to cash flow ratio of 1 to 2. That would allow some incredibly high dividends and buybacks, so it's very likely that the market won't keep them at such a ratio. So any recovery would easily make this a multi-bagger from the current price. However, in such an environment that's quite against Walgreens, that may be very difficult. They have a new CEO which seems to apply the shock therapy that they need. He already cut the dividend in half, which in itself is a very bold but extremely rational move for a stock that paid it for close to 90 consecutive years so far. He's focusing on improving the cash flow, which is again what the company needs. There is a 1 billion cost-cutting target this year and we can see them focusing on closing the unprofitable stores already. This is like the first, quickest and maybe even most efficient thing you can do to reach the target. Then they can look into potential restructurings, firing people, selling parts of the business, buying others and so on. This would be kind of a stabilizing point from which they can get a bit of breathing room and see how they adapt. But as you are about to see in a second, this might be very tough to achieve. Financially, they aren't in a good position from a liquidity point of view, with the current assets not covering the current liabilities. A lot of them are in inventories, which aren't guaranteed to sell immediately, plus account receivables. So it's very likely to see them forced to draw some credit, which isn't good in this environment. On the non-current side, we see that they have some long-term debt and quite a few assets, although a majority of them is in intangibles and goodwill, so potentially close to worthless. They also have litigation expenses they have to pay, a majority of them probably being related to the opioid settlement. There is also a ton of money in treasury stock, but keep in mind, and this is very important, that this is recorded at the price of acquisition, not adjusted to the current price. However, what it means is that the higher the price goes, the better it is for the company, because this can be a huge amount of liquidity even if it's only half the sum. That basically puts the company in a position where if they recover, they can do even better because they would have this liquidity that they can use as tender to buy other companies, for example. Taking out the operating lease assets and liabilities, they have about 15 billion in equity, but taking the goodwill out as well, they actually have nothing. This is why you should look very carefully into the balance sheet, because if you just look at the price to book ratio and see something like 0.5, you might say this is very cheap because of that. So currently losing money on top of this balance sheet and all the market issues is terrible, and you can see how they can get to such a price. The debt also cost them something like $500 million, so paying 800 million as a dividend now is even worse. We see drug manufacturers now look into cutting the middleman, meaning Walgreens, CVS and the rest, and go direct to consumer instead. And these companies can be only the beginning. When you have such blows given to an industry with extremely tight margins, on top of the fundamental issues in retail, it's a very tough position to be in. As a retailer, they don't offer that much value anymore and they don't have a competitive advantage. Back in the day, sure, convenience, the location and so on were advantages, but now with Amazon and everything moving into digital, most people don't need a physical pharmacy anymore. And I think this trend will only continue in their disadvantage and there isn't that much they can do. But even if they manage to get out of the current environment, which they probably can based on what the CEO is doing, the long term will not be easy. They might need a huge restructuring at some point, which can be risky and very hard hard to do. They already do this by branching out into other sectors and developing in e-commerce, but so does everyone, including Amazon. It's one thing for a company like Amazon to do it when they are a $2 trillion company and have access to unlimited capital, and another when you are an $8 billion company that's losing money, can't really issue stock, and already has a bad financial shape. So we can't say, oh, Amazon is doing it, so why can't Walgreens? They are in completely different leagues. Now let's get into a valuation. If they can't recover the cash flow, this would be in a terrible position in the long term. Maybe they can sell some part of the company, downsize and so on and survive, but it would be impossible to know what they would look like. It would very likely be a loss or even a profit, but keep in mind that they don't have such a good balance sheet. If they don't do something relatively fast, they will keep snowballing debt at very high interest rates and would make a recovery less and less likely. If they can recover to, let's say, $1.5 billion in cash flow following the new CEO's plan, they would already be in a much better position. Assuming a ratio of 8, CVS is at like 12 now after crashing, by the way, that's a market cap of 12 billion. That's a price of 13.94, meaning a roughly 60% profit. To be honest, that's very small given the potential risk, but let's look into a more optimistic scenario. If they can get to 3 billion, which would still be among their lowest ever, and the market is trading them at 10 times that amount, that's a 30 billion market cap. That's a price of 34.83, meaning pretty much a 4x. Add the potential double-digit dividends, since they would afford to pay even 3 times more than today on top of the interest, and you can see how this can do well. Sure, 10 may be a bit too optimistic given the industry's future, but even 6 or 8 would be decent, not to mention that the market sentiment can change it to even 12 or more, so there is potential. Can it get back to like 80 or 90? Most likely not, because the company and the industry were completely different a decade ago. They and CVS and so on were making tons of money back then, which is probably what attracted Amazon and all the changes we see today. But the fundamental issues in brick-and-mortar pharma retail remain, so this would only be a first step from which they would have to play it very well. This is a fundamentally risky industry right now that's going through a very significant transition. Maybe focus more on the telehealth business the way Hims and Hers do it, but even there you have Amazon. If they recover, they can buy some medicine producer or a distributor, some online retailer and so on, so there are some ways to be more competitive. Not to mention that there is potential to expand in many other countries by buying the local pharma chains that can offer better margins. So the current US and UK operations can be the solid cash flow provider, while international can be a growth engine, but it's all up to the management. Comparing them to MPW, surprisingly, there isn't really that much shorting going on, so the potential for a short squeeze isn't significant. I'd rather go, and I do already, for MPW since the risk and reward seems simply much better. I'll soon, if I haven't already done it, post a new MPW analysis which I recommend you check out for comparison. Again, it's a matter of risk and reward, and that one is clearly better in my opinion. So overall there is potential, but there is also a lot of risk. If they don't recover, and don't get me wrong, they can do it, especially with all the actions that the new CEO takes, that's it, they go bankrupt or end up in an even more terrible spot. The financials aren't that good based on the company's current cash flow potential, but if they recover to even half of what they were before, that's probably enough for a recovery. Again, on 150 billion in revenue, if they can turn 1-2% into cash flow, they probably shouldn't exist. But if they can do this minimum and manage to change into a less capital intensive business, even on lower revenue, they have potential to pay a huge dividend or buybacks. It's not for me due to the very questionable margins and the way the industry develops, but I can see why some people may be interested. I'd say right now this is a high risk for a medium to high return. I think this is the kind of investment that's either going to be great or absolutely terrible with very little in between. In my opinion, the new CEO is a very positive change, and if they had a chance, he is definitely part of achieving it. Maybe if I see some clearly positive signs and the market doesn't react to them properly, this can be a small high-risk turnaround position. But still, the long term remains pretty uncertain, so I'd maybe see this as more of a short or medium term play, which I don't really do. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.